All right, Emily. So what are we talking about today?
Day trading stocks, robo-advisors, and the change to trade settlement dates.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so a lot of investment stuff today. Why don't you cue us up? What do you want to learn about day trading stocks or robo-advisors or changing trade settlement dates?
Well, this past week I've been studying for my Series 7 exam, so we've been covering a lot of this, so it's on my mind. And I've been learning a lot about day trading stocks specifically, which is not something I know a lot about because we don't do that around here. So a lot of it is new, and it's more complicated than I initially thought. I guess I don't always understand why everyone takes the time and goes through all the buying and calling of options and puts and hedging their bets and all of these things that you can do with the market. We don't do that here. Why not?
Well, I think the why is super easy here. The why is to make money. That's sort of always the purpose on some level. It's to make money and keep the money you have and so on. But day trading is a very different area of investment. So let's talk a little bit about, I guess, what we do, and then we can talk a little bit about what day traders do, and kind of we can then get into what the difference is and why there's a difference, why we as professionals don't do what they do. And yet they are also professionals doing what they do in a different way. So in context of how we manage money, typically for clients, we tend to utilize index funds, particularly passive exchange-traded funds or ETFs. So things like Vanguard ETFs, BlackRock ETFs, all with very low expense ratios, and that typically are just trying to mirror a major index like the S&P 500 or the S&P 600 or the Russell 2000 or a bond index. And effectively the strategy we're trying to follow through on is that we're trying to build a very efficient portfolio to mirror the market as closely as we can. So that way our clients get generally the performance of the market in the allocation that they have, whether it's more aggressive or more conservative. And they do that kind of as cheaply as possible and with as little of an impact as possible in terms of their returns and sort of the movements of the market. And that way there's a lot less judgment involved. There's a lot less, am I smarter than the market? Am I timing the market right? Am I the world's gift to investment management and I'm going to pick all the right stocks and whatnot? We're avoiding all of that and just saying, look, we're just going to get what the market gets as a general rule.
And day traders are looking to really outperform their market, not just match it.
Yeah, because otherwise, why go to all the effort if you're just going to match the market's performance? So to be a day trader is to professionally be pretty indifferent to what you're actually investing in. So you probably don't care so much that you're investing in Apple or Amazon or something like that. You are spending a lot more time looking for inefficiencies in the marketplace where, let's say you think a stock is actually worth 120, but it's currently selling at 100. And so you're going to buy it so that way you can ride it up through 120, or you're going to use an option strategy to capitalize on that if it happens, but you're not going to overcommit to it. So there's a million and one different ways to day trade. But the whole point of day trading is you're really trying to make money as quickly as you can in as short of a time as you can. The analogy that gets used for this often is picking up pennies in front of a steamroller. As long as you're good at what you do, you can keep picking up pennies and making money doing it. But if you make a mistake, you will get crushed.
Does the average person that's day trading really succeed and able to outperform the market?
The average person, absolutely not. But there is such a gross distribution of profits in day trading and professional investing in that sort of sense. To give you an idea, there was a study done a number of years ago that looked at Taiwanese day traders. They looked at 360,000 day traders and found that only about one in 360 could actually outperform the market net of their costs. Editorial pause. Quick correction here. I misquoted the study in this segment. The study, which was Do Individual Day Traders Make Money? Evidence from Taiwan by Barber, Lee, Liu, and Odin, published in May of 2004. The sample size was not 360,000 Taiwanese day traders. It was actually 43,891 day traders. The finding of 1 in 360 outperforming was accurate, but I mixed up my 1 of 360 with the sample size and said 360,000 when it was actually 43,891. With that correction made, let's continue. So when you think about that, that means that, of all the ones that were trying it, right, only 1 out of 360 was succeeding and the other 359 were failing. And I think the other place that I look at this is even just in investment products. If I think about all the actively managed mutual funds, UITs, and so on, statistically, they have a decent shot of beating the market in any given singular year. But as time goes on, they tend to underperform more and more and more. And so the consequence of that, or the byproduct of that, then just means that even though you might make money in the short term, if you're trying to build, let's say, a retirement portfolio, you're typically going to end up underperforming by trying to beat the market. And that's crazy when you think about it, because those firms are wealthy and they have a huge amount of staff, a huge amount of resources. They're paying some of the best and the brightest in the field to try to beat the market consistently. And statistically, they're bad at it. So just what hope does like Scott the gym teacher have, or Karen the librarian? Like, they're wonderful people, our hypothetical gym teacher and librarian, and I wish them all the luck in the world. But just the idea that the average schmuck is going to outperform the markets in general, and certainly outperform the professional investment managers and their professional investment management and research teams, is pretty much laughable. Anybody who beats the market in day trading typically is a statistical anomaly, not somebody who is actually very good at what they do.
And probably wouldn't long term. You say maybe they will for the first year or something, and then not so much.
Well, there's an easy way to think about this too. If you think about the millions and millions and millions of people in the marketplace and just simplify it down to a coin flip, every year everybody flips a coin. And so, if you've got 1 million people, next year you've got 500,000 people, next year you've got 250,000 people, next year you've got 125,000 people. And you just do that year after year after year after year. After 20 or 30 years, you'll still have a couple people who have, through sheer dumb luck, beaten the market every year. But to confuse themselves and think that they are responsible for that instead of just happening to be statistically anomalous is just really, really unlikely.
Well, if you were wanting to be involved in your trading a little bit and fuss around, why wouldn't you just use a robo-advisor? I guess I don't understand the difference.
Well, that's a different story. I think a robo-advisor is sort of a healthy bridge between people who shouldn't day trade and people who need to have the advice of a professional but don't want to pay a lot for it. To give you an idea, the current average CFP professional who manages money for a client has $1 million minimum. The average American does not have $1 million. So right away, the most talented and skilled financial planners, not investment managers, I want to be really careful. I don't think hiring a CFP is a magical recipe for great investment returns. We're not super duper investment specialists. We're broad generalists in financial planning. But in that spirit, if the average wealth manager, investment manager, personal financial advice giver has $1 million minimum, they're going to be inaccessible for the vast majority of the public. And so a robo-advisor is a very cheap and reasonably effective way to get professional investment assistance without paying a huge amount or having to have a ton of money to bring to the table.
How much assistance do they provide? I've never looked at a robo-advisor or even looked at the platform. What do they do for you?
This really depends platform by platform. I would say the most basic stock version of and when I say stock, I mean like off the shelf version of a robo-advisor is going to do one of two things. Either they're going to charge something like 25 to 30 basis points to set an asset allocation for you and then potentially manage that sort of on an active basis for you. They'll probably use ETFs as well, or mutual funds, typically a lot of passive index stuff. And then by extension from that, they might have some more advanced services, and that might be included, or like a pay for extra features to do things like tax loss harvesting or ESG investing or more customized portfolios. Some of them also then offer a very cheap like access to a CFP type service. In that case, you're typically not going to have like a dedicated Dan or Emily working with you. You're going to have, one of 50 or one of 100 CFPs working in like a cubicle call center office somewhere who you can either schedule an appointment with or who you can call like a special line and then just like chat to about your financial circumstances. But just knowing a couple of people who work in that space, for example, Vanguard has what's called private advisor service. The CFPs theirs will typically have something like 200 to 300 clients each, which just when you do the math on that throughout the year means even if they work full time, taking no vacations, et cetera, they're not going to have anything more than like 10 hours to work with you a year, assuming that they don't have any meetings or professional development or anything else on their calendar. So realistically, there's just a little bit of an element of you will pay for what you get and you'll get what you pay for or hope to get what you pay for. And in the robo-advisor space, again, I think they're a good solution for a person who knows they don't know how to manage their own money, but who is probably not ready for a full financial planner. And if they need a financial planner, they can pay cheaply to get some kind of general, non-specific, not deeply personalized advice at a more affordable price point.
What if it's not very personalized, if they don't know your whole situation? Because, of course, they can't. How can the advice be any good? They don't know what else is going on in the other areas of your life.
So that really depends. I mean, some of them will have like a multi-meeting engagement. There are a couple of companies that will say like, hey, you get to have like an initial consult and then like a data gathering and then a plan strategy. It's just very condensed in terms of how much support you get outside of it. Some companies, the robo-advice or the financial planners who work on the robo-advice, their advice is limited just to the portfolio. It's like, hey, you're in this model right now, but let's learn a little bit more about you, and then we can tweak which model you might be in or how you're using it. I think the bigger element there is that sometimes a lot of the people who are going to engage somebody like a robo-advisor are going to have quick wins available to them. So, things that might pop up in a 5-minute conversation. Are you using a high yield savings? No. Let's go find you a high yield savings. Do you have sufficient home and auto insurance? No. We need to get that upgraded or changed. Are you contributing to your company 401k that has a match? No. Well, you should do that. There's free money there. It's like there's a lot of like quick and dirty advice that people can be given. And often they might even know that they should do that already, but sometimes they just need a professional to kind of give them a kick in the butt.
That's true. I found that true personally. That does help. If you're using a robo-advisor, though, how specific can you get? Can you tell it, I don't want to invest in a certain company or a certain industry, or it's a lot more general than that?
It's going to depend by the provider, but a lot of them are going to have sort of, once again, off-the-shelf models for certain ESG objectives. Like, hey, I don't want oil and gas. Well, good news. We have like a green energy portfolio. Or I don't want to invest in tobacco. Okay, we have the ability to like omit funds or companies that have that criteria from it. You're typically going to pay more for that service. And what I would say there is, I don't want to say anybody shouldn't invest or put their money kind of along the line with their ethics or their morals, but just be cautious that, investing via sort of political beliefs or socio beliefs or whatever it is can put you in a position to get suboptimal returns for the level of risk you're taking and the amount of cost you're paying. Because typically your cost is going to go up by creating those restrictions, and your results might vary substantially just because if you're reducing your investment universe by avoiding certain categories, you're fundamentally just increasing your level of risk without a commensurate level of expected return.
I guess that makes sense. Do you find that most people don't go that route then? At the end of the day, they just go with what's generally advised?
I think a lot of people talk a good game about not wanting to invest in certain things. And I've got a sample bias here. I don't have like a good data set here. So I'm just speaking of our clients. I would say probably less than 5% of our clients ask for some version of an ESG investment. And they often only ask for it for like one specific account, but then they want their whole retirement or something invested broadly and sort of generally. I think it's a really interesting area. It's a really interesting topic. I don't think it's well developed enough to have the efficiencies that I'd like to see in portfolios. And that applies whether you're just buying an ESG mutual fund or an ESG ETF, or if you're trying to go to like a robo-advisor to provide a certain tailored level of product. There are some fintech innovations like software services that do help firms like ours provide ESG portfolios and screen for certain things and monitor for violations of certain policies around wanting to invest in a certain way. But otherwise, it's just not hyper efficient in a way that makes sense for most people.
I guess that tracks with what I figured so far. That makes sense.
I do want to circle around a little bit, though, to your kind of what led us to the robo-advisors, which is, should people, instead of day trading, use robos? I'll say somebody who's genuinely going to day trade is not the type of person who's going to use a robo, because they're a hardcore DIY type of person. They want to do their research, do their homework, figure out what they want to invest in, and by doing so, find opportunities in the marketplace and make kind of extra money by finding those arbitrages. The person who uses a robo, I think, is just a person who doesn't have the time or energy or knowledge to manage their own investments, and thus is better off paying for that service to do it for them than they are doing it for themselves. The point of caution that comes up here, though, is that a lot of investors will get a very different result from a robo-advisor than they're expecting, and even their own performance will be very different than what they might think it would be.
What do you find people generally expect when they go into a robo-advisor? Much higher than they're actually going to get?
So the way to think of this, and there's a good study on this by Vanguard, is that there's a different set of expectations for human advisors and for robo-advisors. So the study that Vanguard did compared investors of all ages using human advisors, investors of all ages using robo-advisors, and asked them a lot about like their preferences, what they're looking for, the features they want, so on and so forth. When they got through that study, and there's a whole bunch of dimensions that they compared and found that people who use humans look for one thing and people who look for robos look for a different thing. One of the most interesting pullouts was the expectations of return. So the average client of a human financial advisor expected on their own that they would get about a 10% rate of return left on their own if they were doing it themselves, and that a human advisor could get them 5% a year. So they thought they could get 10 on their own. They think with a human they could get 15. The reality is, in a long-term average sense, it's pretty rare for any investment class to perform north of 10% long-term. But let's say 10% is possible. I think a more accurate way for people using those advisors to think of it would be, hey, on my own, I probably would get only 4, 5, 6, 7%. And if I worked with an investment professional who was utilizing a market-based, passive, index-based approach, and the market was capable of getting 10%, I could get, let's say, 10% through them minus their cost. So if they're charging 1%, right, they're going to get 10 minus their cost. I'm going to get a little bit less than 9% because it's not quite 10 minus 1. But in that particular context, then they're still better off because they're getting 9% instead of what they might have gotten on their own at 4 or 5 or 6%. In turn, with customers of robo-advisors, they tend to expect that they can get 20% a year on their own, which is not a rate of return supported by any asset class on a consistent long-term basis. But also then they think that the robo is going to get them 3%. So they thought they could get 20 on their own. They think with the use of a robo, they're going to get 23%. And the fact of the matter is they're not going to get 20 or 23%. They're probably going to get something like the same results as the human advisor in terms of the investment performance, plus or minus kind of any variance in what services they get and kind of what specificities they want, whether they want broad markets or ESG portfolios and that sort of thing. So the set of expectations for an investor, or kind of the common investor in a robo-advisor, is much higher than they are of a human advisor, but they also have much more unrealistic expectations of their own efficacy as investors in the first place.
Where do those beliefs come from? Is it just the type of person that tends to use a robo-advisor, or it's people that have had expectations like that then turn to a robo to try and increase it even more?
I think the study would say that that's probably a chicken and an egg problem, right? Is it people who have high expectations who use robos, or is it that using a robo gives you high expectations? The most common question or kind of comment I've seen on the study was sort of an assumption that, it's just young people using robos, and they've grown up in a time when the market's been pretty good as a whole. So they don't know that 20% isn't like a normal return. But the study was actually nationally representative and had representation from various age groups all the way up in like the 70s and 80s in both the human and the robo-advisor client groups. So it's not an age thing. It's not an experience thing. I think ultimately there is perhaps just a little less education on the part of robo customers in that they don't quite know what a reasonable expectation is, or perhaps more accurately, they don't have a person, right, a human advisor to help teach them what a reasonable expectation is.
And I suppose the robo-advisor apps and platforms don't do any sort of education in that field to kind of set people up for a reasonable expectation. Do they address that at all?
They're going to have lots and lots and lots of educational material on their website. They'll have their own blogs and like webinars and stuff. And I'm going to bet they actually do a pretty good job of explaining like, hey, a reasonable return is somewhere between here and here based on like your risk tolerance and your risk profile and whether you're going all equity versus more conservative or something. I just suspect that the average user is perhaps not paying attention, is not well informed. I think this is a lot like our para conversation last week, in which I would bet, the same as the para people, the robo-advisors think they've done a terrific job of giving as many explanations as possible about what's a reasonable expectation of an outcome. And the customer base is just not very good at listening.
That sounds about right. Again, I've been guilty of that. So, well, I have another question. This week, there was a change. I'm switching topics now, but in the timeline for settling positions on our platform that we use, it's down to T1 instead. I guess I don't understand why that change even came about and why it wasn't that way in the first place.
Well, first of all, it's not just our platform. So Emily's talking about Charles Schwab, which is where we do our brokerage and investing for our clients. But T+1 is actually essentially a national standard that has been changed. So for reference, for somebody who has no idea what T+1 means, T+1 means trade date plus one for the settlement of funds on a purchase or a sale. So if I trade a stock on Monday, that means the money has to settle by Tuesday. T has changed quite a bit over the years. When I very first started, it was T+3. A couple of years ago, it changed to T+2. Now, as of this week, as we're recording, it's T+1. The argument for longer settlements has always been sort of a security measure. Hey, we want to make sure we kind of take it slow and get it right, and that money isn't moving too fast, mistakes aren't being made. But as computers have created more efficiencies and with the advent of greater technology, the settlement process just ultimately is pretty much automated, or almost entirely automated. So from that context, technologically, it's been possible to do T+1. It could even be possible to just do T or T+0. It just settles the same day. We just haven't gotten there yet. But I think as brokerages and custodians get more comfortable with it, we'll probably stay at T+1 or even move to something shorter if technology stays good, and only if there's like a problem that emerges, like money is going missing or trades aren't happening in a time fast enough, regardless of the technology, then we might see that roll back a little bit. But historically, I mean, there was a time period in which settlement was essentially same day. So like the market would be open all day, all the trades would net out, and then you had like couriers running around New York City with like envelopes of cash to settle up trades and whatnot. So trade settlement has always been just sort of an evolving area of practice, but I think there's a lot of advantages to it switching to T+1.
I would be excited if it switched to just T. Wouldn't it be faster and easier to move money and do the trades, and it's just all same day?
Yes. And I wish I could just say yes, but like at a fundamental level, yes, T or T+0 or T plus like 12 hours or something would be great, just from the standpoint of the faster money moves, the happier all of us are as customers and consumers. I think one of the most common things we have to coach clients on is, hey, if you want money from your investment portfolio, it's not available today. Unless it was already available, like if you want to get money out, we have to trade it. It's going to be subject to market days and settlement time periods, and then you still have to wait on the wire or the ACH or whatever is going to be required there. So it does help a lot because it means we're not forced to sit on money quite as long in the event that something's not available. But on the other end of that, it also just helps from the standpoint of, I think it matches our expectations. Something I've learned over the years, both in finance, but even when I worked in technology for a while, is there's a huge difference between consumer-facing technology, which from a basic level is almost idiot-proof, and business technology or sort of back-office technology where everything sort of is grinding gears and people running around with like wrenches screaming at each other to get things to work. Consumer technology sort of tricked us into thinking that everything is instantaneous. So within that context, even like certain trading apps sort of create the illusion that everything is instantaneous. They'll make money available to you if you sell instantly. They'll let you buy with money that hasn't actually settled yet. If you want to sell something and then buy into something else, they'll sort of smooth it over for your customer experience. But on the back end, there's always been this T+2 or T+1 sort of mechanism where money doesn't actually move as fast as you think it does. And that just doesn't meet our kind of instant gratification culture today.
That would explain my perspective, because I am used to everything happening instantly for just about every platform that I use in other areas of my life.
No. And I think from a user experience, we would all sit there and be like, well, the technology makes it possible, so why isn't it? Why don't we just make it happen that way? And I think the somewhat reasonable pushback is a security concern, a level of safety, secure, and making sure, hey, if everything happens truly instantaneously, there's no way to stop something bad from happening. But if there's even just like a little bit of delay, then that gives us just a little bit of a margin of error to prevent things from getting stolen or misplaced, or to help smooth over mistakes if they happen.
If you were in charge of the decision, then would you keep it T+1 because of security?
Being in charge of the decision for our firm, for our clients, I would love it to be just T. because ultimately we're accountable to our clients. And the T or T+1 thing is really more of a brokerage's problem. So if the brokerages can get the technology and the systems and the processes in place to protect customers, but make it happen faster and more efficiently, I'm 100% in favor of that. Because there is nothing more frustrating than looking at your brokerage and saying, look, like the money's there. We've put in the sales. It should be available. Just let us have it so we can give it to our clients, and having to tell a client, sorry, it's going to be 2 days just because. From our end of business, I would love to see T, or at least keep it at T+1 and never see it go back to 2 or 3. But technology and security and safety are going to drive the decisions there before just my level of impatience.
Do you see it going back and increasing ever? You said back to T2 or T3.
I think if there are problems, we could see it push back to 2 or 3. That's always going to be the pressure, is if it runs smoothly at T1, there's no reason to move backwards. But if there's hiccups and bumps and problems that emerge because of T1, they would move it back for those aforementioned safety issues or security issues.
I guess that makes sense, but I'm sure hoping it stays this way.
Well, you and me both. Or again, T+0 one day. We cross your fingers.
Right, I am.
Well, you've been working on your 7 all of this week. So let me ask, what is the biggest thing you've learned in the past week since we last spoke?
I'm even less interested in day trading than I was before. I think personally for me, people can do whatever they want, but it's so complicated for a slight chance of a higher than average return. I don't see the point. I don't really have any interest in doing day trading. The more I learn about it, the less interested I am.
Well, you work at the right place because we don't do it, and we probably never will.
Perfect. I'll learn all about it. I'll understand it fully. I don't want to do it for my day job.
There you go. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.